Hey family, is the housing market going to crash here in the Central Valley in 2026? I'm getting that question a lot. And the short answer is no, not the way that people think. So, to understand why, you have to stop listening to the national headlines and start looking at what is actually happening right here in Kings County, Tulare County, and the Central Valley. Because real estate, let's face it, is local. This message is especially for families and professionals here in the Central Valley who are, doing well, who are working hard, people looking to build careers and businesses, and wanting to make smart long-term decisions, not emotional ones based on clickbait and headlines. So if that's you, this matters. Every year, the media gives us stories. The market's about to crash, or this is your last chance to buy. And those stories are trigger click bait. They're not clarity. So today I want to slow things down and walk through what 2026 is going to really look like, especially here locally. I'm going to use real data, real trends, real behavior, not fear, not hype. And let's be very clear. A housing market doesn't just crash unless you have massive job losses, forced selling, and excess inventory. And we don't have any of those conditions locally or nationally. Through November 2025, prices still went up a little bit under 1% year over year. That alone, hey, that disqualifies the idea of a crash heading into 2026. Now, let's bring things home. Here in Kings, Tulare, and the Central Valley, we are not seeing panic selling. We're not seeing waves of distressed homeowners. We're not dealing with excess inventory. What we have is moderate, controlled market. Homes that are priced right and prepared well, those are the ones that are selling. And homes priced emotionally, they're sitting. It's not a crash. This is a market that just has become disciplined. And let's face it, discipline is healthy. Now let's talk about interest rates. Yes, rates matter. I know they matter to a lot of people, and we are very rate driven. But what matters even more is affordability. And as we close out 2025, the average 30-year mortgage rate is just sitting above 6%. That seems high, but that is down from the 7 or 8% range we saw a couple years ago. And historically, that's right on point. Most major forecasters look at 2026 and they're saying we are going to be in the high fives and low sixes. But in May, we will be getting a new Fed chair. And that may change a lot. So stay tuned and we'll keep you updated as things progress. What all of that previous information is telling us is that rates are stabilizing. They're not collapsing. And they're not spiking. The Fed is on a downward angle to lower rates. So here's the part that most people are missing though. On December 12th of 2025, the Federal Reserve, they started what's called balance sheet expansion. So they are injecting approximately $40 billion per month into our economy. And why does that matter? Because historically, when you inject that level of money into the system, that puts a lot of upward pressure on asset prices, including especially houses. And at the same time, wage growth is averaging only about 2.7% annually, while the real cost of living and inflation, not just what they're reporting, is probably closer to 8 or 10%. That gap is why affordability stays so tight. And that's why waiting rarely makes housing cheaper over time. Now, a lot of people say, hey, if there's a housing shortage, why don't we just build more homes, right? And on paper, that sounds like a great plan, right? In reality, it's not, because the cost of building has gone up substantially. Materials, labor costs, insurance, especially if you're here in California, and financing. Inflation pressure from all that additional $40 billion is going to make things even worse, and that just doesn't help. Builders are often right now discounting homes. They're offering large incentive packages. They're buying down interest rates just to move inventory. And that cuts directly into their profits. So it just doesn't give them a huge incentive to build fast. So even though demand exists, builders are not putting the pedal to the metal and going full throttle nationwide because their margins are just tighter and it makes risk higher. Makes sense? And that's why we're not heading into a massive construction boom in 2026. With us here locally, things are a little different. We are seeing meaningful growth, Hanford is planning over the next number of years to roughly build 1,500 new homes on the north side. Lemoore has multiple new construction projects underway. Visalia continues to expand, especially north, alongside major new commercial developments. We're going to be in Kings County, we're going to have major commercial stuff. There's talk about Chick-fil-A and Olive Garden, just needing to sign the dotted line to come into Kings County. You're having a new Costco on the north side of Visalia. So all of that drives demand locally. And we're sitting right around a 4% increase right now in the Central Valley. And that data just doesn't suggest in 2026 that it's going to reverse and go into a crash. So let's bring all this home. There's no housing crash coming in 2026 here in the Central Valley. But what is going to continue is affordability pressure, controlled inventory, selective new construction, and opportunity for those who plan well, right? Let's be clear, for those who plan well. So the families who win long term aren't the ones that are trying to time the market. They're the ones that are making decisions using their income, their equity, their taxes, and their life goals. They're not looking at clickbait and seeing things online and making decisions that way. In Kings County, in Tulare County, in the Central Valley, the advantage doesn't go to the loudest voice. It goes to the most prepared. So follow and subscribe for more up-to-date info, and have a blessed day on purpose.